Silver prices are climbing again, and there's a warning signal flashing that most retail investors are completely missing. Smart money, the institutional players, the big funds, they're quietly positioning for a return to $100 silver. But here's what makes this different from the last rally. This time they're not chasing momentum, they're preparing in advance. So what exactly are they seeing that the rest of the market isn't? Let's get into it. Thank you so much for watching. I sincerely appreciate you being here. Today is Friday, May 9th, and we're looking at silver sitting at $77.68 per ounce. That's up 90 cents on the day, or about 1.2%. Gold is also pushing higher, currently at $4,683. That's up $15 or roughly 0.32%. So we're seeing silver outperform gold again today, which has been a recurring pattern over the last couple of weeks. Now when we look at the gold to silver ratio, we're currently at 60.3. We briefly touched below 60 earlier this week, which was significant. For those of you who follow my personal investment approach, you know that the GSR is one of my key indicators for deciding whether to allocate more heavily toward gold or silver. When we're above 60, I tend to favor silver. When we drop below 60, I shift more toward gold. Right now we're in that interesting zone right around 60 where both metals look attractive depending on your time frame and strategy. I also want to point out that silver hit a local low on Thursday of $74.27. We're now up over $3 from that bottom in less than 24 hours. Now that might not seem dramatic compared to some of the moves we saw earlier this year, but what's interesting is the nature of the buying. This isn't retail FOMO rushing in. The volume profile and the way price is moving suggests much larger players are accumulating on these dips, and I think that's a really important signal. So what's driving silver higher today? Well, on the macro level, here we are looking at the US dollar index over the last 5 trading days. You can see the dollar has weakened considerably, down about 0.8% for the week, currently sitting at 102.03. That dollar weakness makes precious metals more attractive to foreign buyers and typically translates directly into higher gold and silver prices. That's the surface-level explanation you'll hear from most market commentators. And here we are looking at the 10-year Treasury yield over the same period. Yields are down about 12 basis points this week, currently sitting at 4.21%. When yields fall, it reduces the opportunity cost of holding non-yielding assets like precious metals. So lower yields combined with a weaker dollar creates a pretty favorable environment for gold and silver in the short term. But I want to dig much deeper than that because I think what's happening beneath the surface is far more significant than these day-to-day macro moves. I've been tracking institutional positioning in the silver market very closely over the last several weeks, and what I'm seeing suggests that smart money is preparing for something big. Let me walk you through the evidence and explain why I think we're heading back to $100 silver, possibly sooner than most people expect. First, let's talk about what I mean by smart money. I'm referring to large institutional investors, hedge funds, family offices, sovereign wealth funds, and professional commodity traders who have resources to conduct deep research and who typically position themselves ahead of major moves rather than chasing them after the fact. These are the players who were buying silver at $18 in 2023 while everyone else was convinced it was a dead asset. These are the players who started accumulating gold below $2,000 while mainstream analysts were calling for $1,500. So what are they doing now? Well, the first signal comes from the Commitments of Traders report, which is published weekly by the Commodity Futures Trading Commission. This report breaks down positioning in futures markets by category of trader. Now, I know COT data can be dense and difficult to interpret, but there's one pattern that's been developing over the last 8 weeks that I think is extremely telling. Managed money, which represents hedge funds and large speculators, has been steadily building long positions in silver futures, even as prices have pulled back from the highs we saw in January. Normally, when price drops, you see managed money liquidate long positions and move to the sidelines. But that's not what's happening this time. Instead, we're seeing these players hold their positions through the volatility and actually add to them on significant dips. That's classic accumulation behavior, and it suggests they have conviction that prices are going higher. At the same time, commercial traders, which typically include producers and large banks, have reduced their short positions substantially. Now, commercials are usually short silver because they're hedging production or providing liquidity to the market. But when their short positions decline, it often indicates they're less confident in lower prices and more concerned about potential upside. The combination of managed money going long while commercials reduce shorts is one of the most bullish setups you can see in the QOT data. The second signal comes from physical market dynamics, and this is where things get really interesting. I've been in contact with several dealers and vault operators, and what they're telling me is that over the last 6 weeks, there's been a noticeable shift in the type of buying they're seeing. Retail investors are still active, but the really significant volume is coming from institutional buyers placing very large orders. We're talking about orders in the millions of dollars, sometimes tens of millions, for physical silver bars and allocated storage. What makes this particularly significant is that these institutional buyers aren't looking for quick flips. They're taking delivery, they're putting metal into allocated storage, and they're planning to hold for extended periods. This is patient capital positioning for a major move. One dealer I spoke with said that in his 20-plus years in the business, he's never seen this level of institutional interest in physical silver outside of the periods right before major price spikes. Here's another piece of evidence. Silver ETF holdings have stabilized after declining through much of last year. The largest silver ETF, which holds over 600 million ounces, saw steady outflows throughout most of 2024 and early 2025 as weak hands capitulated. But over the last 2 months, those outflows have stopped and we're actually starting to see modest inflows again. This suggests that a new wave of investors is entering the market, and based on the size of the inflows, these appear to be institutional allocations rather than retail. Now let's talk about what smart money is seeing that's driving this positioning. I think there are 3 major factors that institutional investors have identified that retail investors are largely overlooking. The first is supply-side fundamentals. Silver mine production has essentially been flat for the last several years, despite prices rising substantially. You would normally expect higher prices to incentivize more production, but that's not happening, and there are good reasons why. Most silver comes as a byproduct of other mining operations, particularly copper, lead, and zinc. You can't just open a pure silver mine overnight. It takes years of exploration, permitting, development, and capital investment. The mining companies that could ramp up silver production are facing challenges on multiple fronts, including rising energy costs, labor shortages, permitting delays, and increasingly difficult geology as the easy deposits have already been mined. Smart money understands that even if silver goes to $150 an ounce, we're not going to see a massive supply response for several years. That creates a situation where price becomes the primary mechanism to ration scarce supply, and if demand continues growing, price has to rise substantially to balance the market. The second factor is the demand side, particularly from the energy transition. Institutional analysts have modeled out the silver requirements for the global solar build-out, the electrification of transportation, the expansion of 5G and eventually 6G networks, and the growth of AI data centers, which require enormous amounts of electricity and therefore more grid infrastructure. All of these trends require silver, and the amounts involved are staggering. According to research from the Silver Institute, solar panel production alone is expected to consume over 160 million ounces of silver annually by 2027. That's nearly 20% of total annual mine production going to just one application. When you add in all the other industrial uses, plus jewelry, plus investment demand, you get a market that's structurally short by over 200 million ounces per year. That deficit has to be filled from above-ground stocks, and those stocks are finite and declining. Smart money has run these numbers. They understand that this isn't a temporary situation that resolves in a year or two. This is a structural deficit that could persist for the rest of the decade unless demand is destroyed by much higher prices or substitution occurs. And for many applications, there simply is no viable substitute for silver's unique properties. The third factor, and I think this is the one that retail investors understand least, is monetary demand. We're living through the largest monetary experiment in human history. Global debt levels are at all-time highs. Central banks have printed trillions of dollars worth of new currency over the last 15 years. Political pressure to keep spending remains intense, and trust in fiat currencies and traditional financial institutions is eroding, particularly among younger demographics. Institutional investors are looking at this landscape and concluding that some portion of portfolios needs to be allocated to hard assets that can't be printed or debased. Gold has historically filled that role, but at $4,600 an ounce, gold is becoming increasingly expensive for many investors. Silver offers similar monetary properties at a much lower per-ounce price point, which makes it accessible to a broader range of investors. If even a small percentage of global investment portfolios shift towards silver as a monetary hedge, the impact would be enormous. The entire global silver market is worth somewhere around $200 billion at current prices. The global bond market is worth over $130 trillion. The global stock market is worth over $100 trillion. If just 1% of capital in bonds and stocks decided to move into silver, that would be over $2 trillion chasing a $200 billion market. The math doesn't work unless prices go much, much higher. Now let me show you some specific examples of smart money positioning that I've come across recently. There have been reports of at least 3 major hedge funds establishing significant long positions in silver over the last quarter. These aren't small positions. We're talking about positions that represent tens of millions of ounces of exposure. One fund in particular that focuses on commodity macro trades reportedly went from zero silver exposure to having silver as one of their top 3 positions by weight. There have also been reports of family offices, which manage wealth for ultra-high net worth individuals, increasing their precious metals allocations with a specific emphasis on silver over gold. The reasoning I've heard from advisors to these family offices is that silver offers better asymmetric return potential. The downside risk is perceived as limited given strong industrial demand, while the upside potential is substantial if monetary demand accelerates. I've also been watching sovereign wealth funds, particularly those from countries that are looking to diversify away from dollar assets. While gold remains the primary vehicle for that diversification, there are indications that some of these funds are beginning to look at silver as well, especially funds that have a longer-term investment horizon and can tolerate higher volatility. Here's what's particularly interesting about this institutional accumulation. It's happening quietly. You're not seeing headlines about it. There aren't press releases announcing major silver positions. This is smart money doing what smart money does best, which is position ahead of the crowd without moving the market against themselves. The fact that we're seeing silver hold up so well despite what appears to be relatively light retail interest tells me that there's significant institutional buying absorbing any selling pressure. Now let's talk about the path to $100 and what would need to happen to get there. At $77, we're talking about a move of roughly 30% to hit 100. That might sound like a lot, but silver moved more than that in just a few weeks during the January spike. The question isn't whether silver can move 30%, it's what catalyst could trigger that move. I see several possible catalysts. The first would be a supply disruption. If one of the major silver-producing countries experiences political instability, labor strikes, or regulatory changes that impact production, that could immediately tighten an already tight market. Peru and Mexico together account for about 35% of global mine production. Any significant disruption in either country would have an immediate impact on prices. The second catalyst would be acceleration in industrial demand. If we see solar installations ramp up faster than expected, or if there's a major technological breakthrough that requires even more silver, that additional demand hitting an already tight market would push prices higher. The third catalyst, and I think this is the most likely, is renewed investment demand. If inflation fears resurface, if there's a currency crisis, if geopolitical tensions escalate, or if trust in the financial system deteriorates further, you could see a rush into precious metals. Given silver's lower price point and higher volatility, it tends to attract more speculative money during these periods, which amplifies moves in both directions. Here's the thing that I think smart money understands better than retail investors. You don't need all of these catalysts to materialize. You only need one or two. And the probability that at least one of these scenarios plays out over the next 6 to 12 months is actually quite high. By positioning now, institutional investors are paying $77 for an asset that could realistically trade at 100 to 150 if any of these catalysts trigger. That's a favorable risk-reward proposition, even if you're wrong about the timing. Let me also point out what smart money is doing on the risk management side. I'm not seeing institutions go all in on silver. What I'm seeing is measured, disciplined allocation of, say, 3 to 7% of portfolios into precious metals with silver, representing a meaningful portion of that allocation. This is prudent diversification, not speculation. If silver doesn't perform, it won't devastate the portfolio. But if silver does what the fundamentals suggest it should do, that 3 to 7% position could generate returns that meaningfully impact overall portfolio performance. I want to show you one more chart that I think illustrates why smart money is so focused on silver right now. This is the silver to gold ratio over the last 10 years. You can see that for most of that period, it took 70 to 90 ounces of silver to buy 1 ounce of gold. During the March 2020 crisis, that ratio spiked to over 120 to 1, which was an extreme outlier. We're currently at 60 to 1, which is actually toward the lower end of that historical range. But here's what's interesting. During previous precious metals bull markets, that ratio has compressed to 50 to 1 or even lower. If we see that kind of compression again, and gold stays around 4,600 or goes higher, silver would need to be trading at $90 or more just to maintain historical ratios. Smart money looks at charts like this and sees mean reversion potential on top of all the fundamental reasons to be bullish. You can see right now silver is sitting at $77.83. I'm really curious to see if we can break through $80 cleanly next week and start building toward that $100 level. The fact that we're seeing strong institutional accumulation at these levels tells me the risk-reward is still favorable even after the rally we've already had. Let me know what you think down in the comments section. Are you seeing similar signs of institutional accumulation? Are you positioned for a move back to $100 silver? I'd love to hear your perspective. Thank you so much for watching The Capital Wire, and I will see you all in my next one.